Hey everyone, John Henry here, Slingshot Futures Trading Group, SSFTG. I had a question from one of our chat room members asking about, what is it that we use the morning DP levels for? How do we utilize them most effectively? I know I've done a lot of videos on what they are and how they work and generally what they're for, but going in a little bit deeper, how do I use them, right? What do I use them for, and why are they so important? Now, whether or not you're calculating your own DPs or not, your DP levels may be a little bit off from mine. It depends on the time that you calculate them. But generally speaking, they're going to be relatively close if you've watched some of the previous videos. But what I'm looking for in terms of these levels, and if you don't know what I'm talking about, I'm referencing these dashed and solid levels going across. So what these levels are, just so that we're on the same page, are what we post every single morning over on SSFTG. So you can find those over on SSFTG. If you go into the morning brief on the top, you will see those posted every single morning that goes over all of the major ones. And they're updated daily. So what are these, right? What the heck are we looking at here? So these levels are the DP expansions beyond the settlement point. So settlement, this is nothing more than where the market closed yesterday. So from that area, based on historical information and historical volatility, how far is likely for the market to go? How far up can it likely go? How far down can it likely go? Now, there will be those scenarios where it goes a lot farther than people thought it would, and that's why they're called, well, standard deviations and averages, because there are going to be those times where the market deviates way outside of it. But generally speaking, what we are looking at here, that is incredibly large font. Let me kick that down a notch here. This is the negative 0.5. This one is the positive 0.5. This one is the negative 1. The orange is the positive 1. The red is the negative 1.5. The positive red is the positive 1.5. And then finally we have the negative 2 and the positive 2. Now, what do these mean, right? So if we're looking at this from a probability perspective, think standard deviations. If you're not familiar with standard deviations, I would strongly encourage you to look them up because that's basically how the markets operate. But as far as the standard deviations, this is telling us that within a 38% likelihood, roughly, the market should stay and close by the end of the day underneath this price, as well as above this price. Right? Roughly 36 to 38% of the time based on standard distribution. Now, basically, if you clump these together, that tells us that, about 65-70% of the time, the market shouldn't get outside of this. That's pretty important information. But if we take that a step further, because, well, 0.5 isn't exactly huge some days, when we start reaching out to the positive 1, now we have a very high likelihood that the market is going to stay in these bounds. Generally speaking, the market is going to stay under this or above this, depending on what side you're looking at, roughly 85-86% of the time. It's very, very likely that the market will close inside of this. Now, there will be days that is not the case. But let's take as an example an options trader who's looking to play an iron condor. Well, generally speaking, you know that you should be profitable inside this range. That does also mean that at that range, it's probably not going to be very profitable because, well, the market obviously knows that too. So what am I looking at these at, right? If we're at a negative 1, what does that mean? What about a negative 1.5? Well, if we're at a negative 1.5, now you're looking at 96% likelihood that we stay inside of this range by the end of the day. And if you go all the way out to the 2 DP, you're looking at almost 98 to 99% likelihood that the market will stay inside this range by the end of the day. So how is that useful, right? Okay, so what? Right? Why does that matter, right? Well, what I like using this for, and what I love the DP levels mostly for, is combining probabilities with structure. If I can find a situation, let's just take a really blanket easy state and go from the bottom all the way up. We've got an L5, we've got another continuation off of an L4. Typically, L4s should procure an L1 bounce. So if I'm looking for a continuation to the upside and I want to be a buyer in the most probabilistic location, then the negative half DP sitting right inside my L1 area is exactly the spot that I would be looking for. Because probabilistically, we shouldn't be closing underneath this side of it by about 38%. Now, that's not that much, right? That doesn't help me a whole lot. So when I'm looking at the DP levels, I like looking when the market is really screaming, really getting way, way out there. Let's take gold as an example. Gold has had some incredible movement today, and this would be a really good example of how we do still have some incredible support resistance at the half DP and at the 1 DP. Doesn't look like anything happened at the 1.5. There's a little bit back here, but that would have been days away. And then we finally have resistance at the 2. And again, from this point, by the end of the day, it is an insanely high likelihood that the market is going to close underneath that. Will it always? No, of course not. Does that mean that it should turn around as soon as it hits the positive 2 DP? Of course not. It could go all the way through it up to a positive 4 DP before collapsing all the way down and closing at the end of the day. But what we have to understand here is that by the end of the day, probability dictates that the market should stay within this realm by a very high degree. A little bit less of a degree, again, about 98, 99% on the 2 DP, around 95, 96% on the 1.5. When you're at the 1 DP, you're a little bit lower, closer to like the 83s, 84s, 85s, and then over here, you're closer to like the 38s to 40s. So we have our ranges, and what I'm looking for is something to line up. Like I said, structure with probability. What do we have here? Very obvious, massive structural support and resistance. What do we have lining up exactly around that area? If the market on gold were to dive down, you better believe this is a monstrous area of support, not just structurally, but also based in probability. Now, the way that these DP levels work, they're dynamic. So if you were, let's say, as an example, to go from settlement all the way up to a half DP, to a positive 1 DP, and then go all the way down to a negative half DP, you've effectively moved 1.5 DPs, right? 1.5 standard deviations from the top to the bottom. And that would suggest then that you have likely, again, based on the probabilities, that would be a 1.5. So a 1.5 has an 85% likelihood, if that was a scenario, to stay above by the end of the day. So remember, these are dynamic, but don't add all the little ones in between. If we were to start here and go all the way up to the 2 and drop all the way down to the negative half, that is a 2.5. It's not like a 4.5 or whatever. It's a 2.5 because that's how far it went up, plus another half to the downside. But that's really it. I'm utilizing them as barriers or areas of interest that I can also combine with structure. As an example, perfect example is actually really nice. 2 DP on top of major structural support resistance, that's where the market decided to start turning around. Did it go above it first a little bit? Yeah. Don't expect these levels to be exact every single time, but algos are pretty consistent and they love showing up when the probability is in their favor. So that's going to do it for this one. Hopefully this clarifies and helps out a little bit, but if you have any more questions, drop them in the comments below or shoot me an email, jhb@ssftg.com. Until the next one, enjoy, rest up, and we'll see you all then. Thanks.